All right, good morning, Freeman CPA. Here again, going to discuss today reasonable compensation for S corporations. So what is reasonable compensation and why is it important? And what does it have to do with anything that pertains to taxation? So when you're going to establish an LLC or a regular C Corp, before you do anything and you decide you want to convert it to an S Corp for tax purposes, an LLC or a C Corp can do this. Now the thing with converting your entity to a C Corp, you're changing taxation, you're changing how that entity will be taxed going forward. An LLC will be taxed differently, a C Corp will be taxed completely differently than an S Corp. So once you're established as an S Corp, you must run a reasonable salary or compensation for your services from profits. So why is this important? Why does the IRS want you to do a reasonable compensation? Well, in a nutshell, you start to regulate payroll taxes. Whenever you're paying yourself a W-2 here, you're basically determining how much payroll taxes you're going to be paying. So for every single paycheck that you're running, you're incurring payroll taxes. So let's take a look at an LLC versus S Corp. Right? You have $100,000 in profit and $100,000 in profit here and here. All of this $100,000 will be subject to what we call self-employment tax. You might ask yourself, well, how much is the self-employment tax? It consists of Social Security and Medicare. This is basically 6.2% currently and 1.45% for a total of 7.65%. And since you're an LLC, you're considered self-employed, and that means you're an employer and employee at the same time. So basically the 765 times 2 equals 15.3%. That's a lot of taxes, folks. So $100,000, you're going to be paying $15,300. I'm not going to go into the details. There is a shave off of 92.35%, but you'll be paying approximately $15,300 on $100,000 of profit on top. So this is just the self-employment tax. This is not income tax. This would be on top of your income taxes. So it's very expensive to have a profitable LLC. There's a lot of mechanics that go on. Don't automatically run out and get yourself an S Corp because taxation is very complicated. There's different taxes that get involved. One has different QBID than the other. You have city taxes that come into play depending on where you're located. Like in New York City, you have the NYC General Corporate Tax, where New York City disregards S status and taxes the entity as a regular C corporation and has a 9% tax. So you might be paying a heck of a lot here with self-employment, but here in New York City, you'll be getting slammed with New York City General Corporate Tax. Don't run out and get an S Corp and right away think that what I showed you here is an all in all. I'm just explaining reasonable salary. Okay, so But you understand now how expensive this is. But what happens with the S corp? Why am I comparing this to the S corp? Well, because here you're paying $15,300 in self-employment tax, and here you have a W-2, and here you have to determine your salary. You're going to say, well, I'm going to pay myself $60,000, right, on a W-2, and then that's going to be taxed at 765%, right? So my self-employment tax is going to be much smaller here than it is here, because all I'm taxing here is 7.65% for the employer portion, but there is also an employee withholding. Don't forget, when you're getting your W-2, the employer ER is matching your 60K and is also paying so it's the same 15.3%, but just part of it's coming from the employee and part of it's coming from the employer. So it's the same 15.3, but the difference is the wage base is 60,000 versus 100,000. So the savings of 40,000 times 15.3%, you know, that's over $5,000 in savings. But again, the mechanics work differently because there'll be other moving parts to this whole thing. You know, with an S corp, if we're talking about a single shareholder or a single member LLC, you have vast differences in how everything's going to look, because once you have an S corp, I have to file a separate filing. So even though I might be saving, let's say 5K, I'm saving here, I might be losing my QBID deduction, and here I'll have a greater QBID deduction. Here I also have payroll processing costs, right? So I have payroll processing costs here, and then I have to pay an accountant. That's us. Maybe $3,000 for running an S corp, because I have a separate filing. I have to file an 1120S. It's a separate filing. It's a more complicated filing. I have a W-2. I have to run payroll, and it's no longer, I'm just filing a Schedule C with my personal 1040 tax return, and I'm done. Much simpler filing, no payroll processing. So that's the differences between having an LLC. I'm not going to get into a C corp. That's a whole other world. But that's just basically, these are the most common setups. Nobody goes out and gets a C corp in our world, because for most part, C corps are for bigger companies or for very specific business reasons. People don't get C corporations unless there's, for example, foreign ownership, or maybe they want to go public one day, kind of like your Pepsi-Cola or something like that. That's the reason to get a C corp. Otherwise, we don't typically see C corporations. A very expensive form of doing business, even under that 21% tax rate that the Trump administration had reformed into, where, you know, having a C corporation before 2018, it was the highest taxes in the world. We were known for the highest taxes in the world. That's why all our entities were going overseas trying to cut the taxes and do business out, you know, basically in foreign territory. But that's C corp world. I'm not going to get into that. So most small businesses basically are going to go for an LLC or an S corporation, and that's where we get hired, is when people come to us and say, well, what's the difference between an LLC and an S corp? How should I start up? Should I start up with an LLC? Should I convert my LLC to an S corp? Should I just keep it as an LLC? Should I just start as an S corp? And we explain this. We basically are showing you the differences in taxation, and it's still not straightforward, because there's so many moving parts. Things might look very differently 2 years down the road, and we can't tell you, yes, do this and it'll definitely save you more money in taxes, or do that and it'll be better off, because things change all the time. So it would be very bad advice to say, yeah, definitely go do it. Now, back in the day, before the qualified business income deduction, and if we were looking at income tax-free states like Florida, it was a no-brainer. Usually you want to go the S-Corp route. It was definitely going to save you money in taxes legitimately. It's a great strategy. You're regulating your salary, so as long as you have that reasonable compensation going, you're doing well and you're saving yourself in taxes, but that no longer really applies to everybody. And again, you have to weigh out everything. You have to factor in accounting costs, extra filing costs, payroll processing, and all that other stuff to kind of get an idea if it's actually worth it or not. And anyway, so what is reasonable compensation? So once you get that S corporation, the IRS is going to send you a notice and say basically, you must now run a reasonable salary. And it's very vague, because what's a reasonable salary? You know, if I'm profiting 100K, what should I pay myself? Well, you know, that's kind of like, that's where we come in and try to help people. Now, there's companies out there that do reasonable compensation. What's that word I'm looking for? Reporting. So they'll look at your company and you'll pay them a fee, and they'll basically issue you a reasonable compensation report and say, well, based on your input, we feel that you should always pay yourself $50,000, and then you know you're basically covering your bases. But what happens if you don't run a reasonable salary? You say, oh, the heck with all of that. You know, I know I'm saving money. I'm basically going to skip on payroll taxes or self-employment tax or the FICA tax, whatever you want to call it. These are interchangeable, by the way. Payroll tax and FICA is really Social Security and Medicare, what we just talked about. But this is the same, right? Payroll tax, FICA, and Social Security. These are all basically interchangeable with self-employment tax, because we're still talking about the same Social Security and Medicare taxes. It's still that 6.2% and 1.45%. This is the same exact thing. Okay? It's just hiding under different names. So what's to stop me from basically, well, I made 100K, I'm going to pay myself 0 salary. I just saved myself a bunch of payroll tax, right? 15.3%. I'm smarter than everybody. No, because the IRS says that if you have an S Corp, you must run a reasonable salary. And what's going to happen if I don't? Well, I'm going to need to pull this money out, folks. So I made this profit. I'm going to want to pull it out of my business, and then I'm going to be filing an S Corp, an 1120S for S Corp, and that's going to get reported. So as I'm pulling this money out, that's going to be classified as distributions of profit. And that must be reported on your 1120S K1 form, okay? And once that's reported, the IRS basically knows that you pulled out all your money as a distribution, because it has to be reported in the K1, which will travel to your 1040. Remember, 1120s are non-taxable entities. They don't pay income tax. So whatever happens with the 1120S, rather, it all has to flow from the 1120S to the K1 to you as a shareholder, because it does not pay tax. This entity is a non-taxable entity. It's a pass-through entity, as we call it in the world of tax. It passes through whatever activity it has in this K1 form, and it lands to your 1040, and it's going to say 0 salary, but everything was distributed to this person. And the IRS is going to know that. And what can they do? They can do a salary audit. I've yet to see one. I haven't seen a salary audit, but I know they exist. And they can say, well, you know, the last 3 years, Bob, you paid yourself, you know, you basically pulled out 300K, you paid $0 in payroll tax, and you skipped out, you did away like a bandit on payroll taxes, while the rest of us are all working, paying ourselves a W-2, or if we're an LLC, we're paying everything on it to Social Security and Medicare. You know, you basically just skipped on payroll taxes. Okay, so they're going to foot you a bill potentially and say, well, out of that 300K, I don't know, pick a number, 60%, we're going to reclassify those distributions as reasonable compensation, and that's called a salary audit, and then they're going to give you a bill for not paying yourself that salary, and that's payroll tax avoidance. All right, so you've skipped on payroll tax. Maybe it's even evasion, right? if you do it willfully. Now, basically skipped out on this. And now what they're going to do is they're going to give you a bill, and since it's payroll taxes are considered trust taxes. The government's entrusting you with that money. So when you're paying an employee, you're holding on to some of their taxes, and then you're remitting those taxes over to the government. You're holding on to that employee's income tax and their Social Security and Medicare tax, and if they're in a state and city, you're also holding on to state and city taxes from their pay, and you're giving them a net paycheck. So if I paid an employee $100, they're going to get $62 in net pay. The difference I'm holding on in the form of taxes withheld of all various types, and the government's entrusting me with these taxes, and I send it over with my matching portion to the government. So when I don't do that, there's people out there that don't do that for years, and they're basically thieves. They basically steal from the government, they steal from their employees, and they go on like that for years, and then the IRS comes around and slams them for basically stealing. That's why they're called trust taxes, because the government's entrusting you to basically be the middleman for them. And that's why they penalize that very heavily, and they have those as some of the worst penalties. By the way, sales taxes are also trust taxes, and they're penalized in the same fashion quite heavily, because the government's entrusting you, and if you don't do what you're supposed to do, you're basically stealing from the government, and they take that very seriously, as we do here as well. So anyway, so the government will give you a big, recategorization of your salary, slap you with a bill, and tell you don't do that again. That's what will happen. Now you're scared, and you're like, well, oh my God, I don't need any of these problems. How do I pay myself a reasonable salary, Greg? Well, that's a great question. Now, what you got to do is basically break out your salary into different components, right? So how much of your day is spent on admin? How much is technical work? How much is specialty work, right? How much is fancy CEO work, and so on? Because my day is made up of very different aspects. I pick up the phone, I write emails, I take out the trash, whatever. I also do highly specialized work, right? I do tax planning, tax projections, I speak with clients. That's CEO work and specialty work. I can be technical, where I'm actually processing tax returns, or I'm doing financial statement preparation, bookkeeping. This is more technical, but all of these services are valued differently, right? Where this is valued 2 times, this would be valued 3 times as much, and this will be valued 4 times as much. So I have to sit down and create a file, okay, with how I arrived to my reasonable comp. And I'm going to use RC as the acronym for reasonable compensation. All right. So because I want to audit proof how much salary I'm getting, so that way it can't be questioned. So if my day is 5% admin, I spend a good 30% here, and then the rest is 65%, right? I'm spending on more specialty and CEO type work, then I have to value it based off of some sort of methodology like this to arrive at my reasonable compensation for the year. And that can change. But this is just kind of one factor. It's never just, I'm going to sit down and blindly say, I'm going to always pay myself $50,000. Because what happens if I'm a startup? And all I've been doing, here's my brand new business, it's year 1, and I'm a startup corp, right? S for S corp. And all I've been doing is, here's me, I'm going to draw a little stick figure with a bunch of cash in my hand, and all I'm doing is putting money into my startup. I'm funding it with my hard-earned cash. Now, this cash has already been taxed, right? It's been taxed already. So I'm putting this money in here to start up my corp, and this corp is spending money. It's spending money out the door. Here's my door, right? And I'm building up this brand new business. So would I run a reasonable salary if I have 0 profits, $0 in profit, and all I have is losses for that year 2. So what am I going to do, folks? Am I going to take money that's already been taxed for payroll and income taxes that I'm funding into this company to create losses to run a salary by law because that's my requirement? Well, no, of course not. Because then I'm basically taking money that's already taxed and putting it through a tax again. That would be double taxation. So we wouldn't do that. So we can't just blindly say, yes, by law I'm required to run a reasonable salary, but I'll run that reasonable salary no matter what. Because that would be preposterous. So I don't want to do that. I want to make sure that there's a methodology and the timing is right to run that reasonable salary. I'll give you another example. Here's year 1. I made $60,000 in profits. P for profits. Here's year 2. Year started off slow. I don't make money if this is January all the way through December, and I only started making money here, let's say from July to December. I've profited 60K. So for me to run a salary in this time period right here, I would be pulling out the salary from something I've already basically paid taxes on one way or another. So I don't want to put it through this rigmarole again, because whatever happened here, I would only start to take a salary once I become profitable again. Here I might be just flatlining like $0. So I'm not going to just run a salary for the sake of running it. I'm going to distribute my prior year profits. That's how that works. Okay? Now, what happens if I'm profitable? How much should I take of this 100K? Well, we have a general rule of thumb, okay? Besides fancy footwork and really understanding all these different layers, yes, I'm admin, yes, I'm technical, yes, I'm specialty, yes, I'm CEO, all that. Well, can you simplify it for me, Greg? Okay, sure, 50%. Take 50% before your salary as a reasonable comp. If you want to be extra safe, go with 65%. I don't recommend this. This is just a general rule of thumb. There's no law, there's no reasoning, there's no methodology, nothing. Zip doodah. This is just basic, hey, this is what we think we should basically just do just because we're going like this. That's not how you come to a reasonable salary, but we'd like to see you at least hit these marks. That's our industry rule of thumb. All right. Now that you've understood that, you might also include as part of your file, that reasonable comp file, you might want to look on hot jobs. See what others are paying for somebody like yourself for those tasks. So that way you can see, well, somebody doing what I do for that part of my job, they would get, let's say, $150,000. So that's another way to kind of get to determine how much you're actually worth. And then you have to see how much you're profiting. You might be worth $200,000 easily. I know I am, right? But if all I have is $100,000, what am I going to do? Put money into my corp or borrow money to pay myself $200K? No, that's not reasonable. The whole idea is reasonable. And that's why they're so vague, the IRS. That they tell you, be careful. When you get that first notice from the IRS, they're going to say, by law, you're required to run a reasonable salary. Make sure you're doing that, or we're going to, if we ever audit you, and they actually say that in that notice, if we ever audit you, we'll determine your salary for you. So you don't want to do that. And you don't want to wait for that to happen. So anyway, that's basically the gist. And by the way, you can also be profitable, but you might be running off of loans and things like that. You have to assess every situation differently. There's no one set of circumstances, and every business is different. Everybody's doing something different, and that's why we can't just automatically say this is what you should get paid. And we're definitely in no position to give you that. That's why there's companies out there that do reasonable compensation reports, because they'll study your specific industry, your specific services, your specific situation, and give you that report and say, this is basically what we feel you should be paying yourself to cover your bases, right? And we're just accountants, we're tax people. We can say, this is tax law, you have to pay yourself a salary, or you're skipping out on payroll taxes and you can get into a salary audit. And we'd like to see about 50 to 60% somewhere along those lines as a general rule of thumb. And then kind of just be also there on the lookout. Well, do I have 100? Does the owner want to pay 200? Is there a point in it? And just kind of be that sort of benchmark for people, but not the one that will say to the client, yes, you should pay yourself 65K. Because I have no idea what you're worth or what you would pay somebody else to do the same job for you. So therefore, I'm not in the best position to give you that kind of advice. Although, believe it, every single client we have here with a business, and that's many people, come to me and they'll literally ask me, how much should I pay myself? And I will have the same exact answer. I'll say, I don't know. I know that you should be paying yourself a reasonable salary. You should weigh what you do. You should look at your profits. You should look at where the money's coming from every year, understanding that component and seeing what you're actually worth to your business and what your business can afford. It would be no different than you going out and hiring somebody. If I wanted to hire, for example, a tax professional here, I would sit down and say, well, what are they worth on the market? How skilled are they? Can they answer all my questions in the interview without a problem? Are they worth 90,000? Are they worth 100,000? And we would assess that internally between my partner and I and decide if that's the person that we want to hire based off of their credentials, their work experience, their history, and everything down the road. And will they actually make money for us? Or are they going to be like a money pit where you give them work and they take 20 hours to do something that can take 5 hours to do, that should take 5 hours to do? That's how you assess it. No different than you were hiring a person. So that's basically reasonable compensation, folks, for S corporations. Why it's important to understand the rules and run the reasonable salary, differences in taxation for S corporations, and basically what you stand to gain by doing work on your S corp by solidifying that salary and audit proofing it by creating a file for yourselves. All right, well, that's it here from Framing CPA. I wanted to wish everybody a great day. Thank you for watching. And remember, our motto here at Framing CPA is your success is our success each and every day. Thank you. Have a great one.